Hey there, future homeowners. Are you dreaming of unlocking the door to your very own home but feeling overwhelmed by the process? Don't worry. As someone that has purchased 9 homes in the past 7 years, I'll be diving into everything you need to know about buying your first home. From financing and budgeting, all the way to closing the deal and doing some move in best practices. I'll be covering the following aspects today: financing and budgeting, finding a realtor, finding a loan officer and getting pre approved, touring a home, putting down an offer, going through due diligence and inspection, preparing for closing, and what to do after closing. Before we start, you may be wondering, why am I wearing this ugly sweater? Well, the answer is when I recorded this, it was Christmas. So, Merry Christmas and Happy Holidays to everyone. Let's start with financing and budgeting. It's essential to assess your financial situation. This starts with understanding your credit score, income, debts, and savings. Looking carefully at your budget and expense tracking. I deep dive into this topic in my video shown above here, but for now, what's important is to have clear line of sight on what your reliable monthly income is and what your monthly living expenses are. Once you have this calculated, you will be able to know how much remains that can be used towards a future home's mortgage, paying down maintenance and repairs, and of course, utilities. This, along with knowing how much you have saved up towards a down payment and closing costs, which will be anywhere from 2 to 5% of the loan amount, are a great place to start in determining how much you'll be able to responsibly afford. If you have a poor credit score, it will be worthwhile to address this before purchasing a home. Assuming nothing in a mortgage application changes except the credit score, someone with a score in the 680 to 699 range would have a mortgage rate approximately zero point 0.4 percentage points higher than a person with a 760 to 850 score. Now, this may not sound like a lot, but it plays a huge difference. For example, assuming a $244,000 loan, in just 20 years, the person with a lower credit score will pay $20,000 more in just interest compared to the person with a 760 or higher score. Here's another look at just how impactful your credit score is. Comparing the lowest tier credit score with the highest tier, the former will pay $240 more each month for the mortgage due to a higher interest rate. In 30 years, this translates to $85,000 more towards interest. But unfortunately, life can't be easy, and loan institutions use a different, typically older FICO version than what the credit card companies use. So although using the free FICO score that your card company offers may provide a rough estimate, it may not actually be the score that is used for your loan. Most loan institutions will use FICO version 5, which is made up of the below factors. The highest contributor is payment history at 35%. Simply put, if you have late payments on loans or credit cards, you'll need to pay them off and then demonstrate having no late payments for around several months until you start seeing your score increase. The next highest contributor is your credit utilization, making up 30% of your credit score. The lower your credit utilization, the better. So say I have a credit card with $1,000 credit on it. I would intentionally never have more than $200 as a balance on it. It is better to have many credit cards and keep their utilization low. I myself have around 8 credit cards with a total of around $100,000 of monthly credit. But there's no way I would ever use that much. Instead, across my business and my personal expenses, I only use around $6,000 each month. People with the best scores tend to have an average credit utilization ratio of less than 6%. But I myself have seen keeping utilization below 20% to result in a high credit score. Next up, we have credit history length, making up 15% of your score. This is determined by taking the length of time each account has been open for and the length of time since the last account was open. So if you recently began establishing your credit, then be prepared to wait until you see your score increase. Next, we have new credit sitting at 10%. I'm not going to lie, folks. This one doesn't make sense to me. I'd simply say this: don't go crazy in opening up a ton of new accounts if you don't plan on using 6 to 10% of the credit balance. It won't be necessary. And lastly, credit mix making up 10% of your credit. Only having credit cards won't get you the highest possible score, but having car loans or educational loans that are paid on time will help boost your score. Okay, sticking on the financial topic, another thing worth doing is learning about the different types of home loans that exist and seeing which one is best for you. Some common examples include conventional fixed rate loans. These are great for individuals with a 740 credit score or above and offer down payment options from as low as 5% or higher. There are also FHA loans, great for folks with low credit score or for those that want to put down as low as 3.5% down, but willing to also accept a required PMI, private mortgage insurance, and depending on the interest rate, may result in a much higher mortgage. But when interest rates are low, folks, a 3.5% down FHA loan is an amazing thing. I myself have bought a $373,000 duplex for 3.5% down at a 2.5% 30-year interest rate. This is a deal I would never pass up. But let's be honest, those days may be gone for a very long time, as right now in 2024, we're seeing average 30-year interest rates hover around the 6.5 to 7%. That's just something we all are going to have to deal with for some time. Now, there are also VA loans, an amazing option for those in active duty, veterans, and qualifying family members of the U.S. Armed Forces. And there's also adjustable rate loans, also known as ARM loans. This is one of my least recommended options for first-time homeowners. Although these type of loans will initially offer a lower interest rate, the risk is that the rate will change after a period between 1 to 3 years. This level of uncertainty can be catastrophic if rates increase substantially over time, which is why these are normally used when someone is looking to sell or refinance the home to a different loan type before that 1 to 3 year term ends. Okay, let's move on to the next topic. But real quick, if you are finding this video informative, please consider giving it a like. It really does help me expand my reach and hopefully helping more people. Also, I strongly encourage checking out my 2 curated homeowners playlists shown above here, where I share DIY do-it-yourself repair and renovations and things to do when moving into a new home. Okay, on to finding a good realtor. There's this dangerous belief circling the internet that a realtor is no longer needed, given that people feel that they know everything there is to know thanks to Zillow and the internet. But please don't fall into this trap. A good realtor brings knowledge of a localized market, has access to a professional network of inspectors, lenders, and contractors. They are specialized negotiators in real estate. They help coordinate tours. They handle all the legal paperwork. And best of all, they represent and guide you through each step of the process. Even today, after buying 9 homes in the last 7 years, I still use a realtor. Sure, after 9 homes, I mainly rely on them for the paperwork and market analysis, as I've built my own network of professionals and gotten very good at negotiating real estate. But a bad realtor will not only be a waste of money, but may land you a very bad purchase. So be sure to research for realtors with good reviews, a proven track record like mine, who had over $10 million in sales already, and a local market knowledge. Also, interview multiple realtors, asking about their experience, approach, and fees. And lastly, ensure they are licensed and have relevant certifications. Once you have a good realtor, the first thing you both will do is discuss what your must-haves, your nice-to-haves, and your deal breakers are in a home. From there, either you or your realtor can begin searching for homes that meet these criteria and begin scheduling tours. I shared an example of how I use Zillow to conduct my own research. If you're interested, be sure to check that out later. Now, let's fast forward to you and your realtor scheduling tours. During the tour, be sure to stay organized. For each home you tour, take notes and photos of any red flags and green flags during that tour. And while you are touring, inquire with your realtor about the neighborhood, schools, and any potential issues that the home or area may have. I have a specific playlist where I share learnings from my 9 home inspections on things you should keep an eye out for when touring. This is a must watch, folks, prior to beginning during tours. Oh, and I can't forget the importance of also researching for a loan officer or broker. I recommend for you to ask your realtor which mortgage broker or officer they work well with. This person can easily cause a deal to collapse, as they are responsible for working with you, the closing attorneys, and underwriters to get your financing completed. Similar to researching for high quality realtors, you'll want to do the same here. It's important to know upfront what the loan officer or what their broker's fees and rates are, as this can vary greatly. Once you have identified someone, it's now time to get pre-approved. This is effectively the loan officer saying that they've reviewed enough of your finances to have confidence that you will be able to get approved for financing up to a certain amount and up to a certain interest rate. Being pre-approved will make your offer stand out more, but in some markets may even be expected. Your loan officer will likely require your income statements, tax returns, and run your credit. So start planning to have these handy. Okay, let's fast forward to the point where you are ready to make an offer on a home. The number one thing to do here is to consult your realtor on how to best approach things. A good realtor will guide you in discussing the price, estimated closing date, advanced strategies such as putting an escalation clause in times where homes are getting multiple bids, and also what the due diligence length will be. A due diligence period is the time you and your team have to schedule appraisals, inspections, and research that the home's title has no issues with it. If any issues come up during this due diligence time that makes you want to back out of the deal, you can do so and still recover your earnest money. Your realtor will also discuss with you any contingencies or terms to include in the offer to sweeten your offer. Unless given very rare scenarios, I strongly discourage you from considering waiving certain contingencies, such as financing, appraisal, and a clean title. This would really increase your risk of losing your earnest money if the deal falls through for any of these reasons. Once you and your realtor land on a game plan, next is to decide how much to put for the earnest money. This money will be held in escrow by your realtor's broker, and is a way for the seller to gauge just how serious you are in your offer. I normally provide a very high earnest money for my homes, up to 5% of the asking price, but normally they are closer to around 1 to 3%. Once all of this has been agreed upon, your realtor will then draft everything up in an offer letter and share it with you to sign. At this point, be prepared for the initial round of negotiations, as the seller may come back with a counteroffer. Again, consult your realtor and ensure you stay within your budget. Also, keep in mind that there will be another round of negotiations after the inspection, so it's okay if you don't get the best deal at this point in time. Okay, let's assume that your offer has been accepted. Congratulations, you have now gone under contract and your due diligence period has started. It's now time to move quickly and become very communicative with your loan officer and your realtor. Your loan officer will handle coordinating with everyone to approve your financing, but it is your responsibility to provide them with everything they ask for in a very timely manner. This will likely include all your assets and debts, 1 or 2 of the most recent pay stubs, and 1 or 2 of the most recent bank statements that will be used to fund the purchase. Respond to their communication quickly. There is no time to lose. While your loan officer works that front, you and your realtor need to begin hiring an inspector. This arguably is the most important part of the process, as the inspection will inform of any potential missed issues that could cost you several tens of thousands of dollars down the line, or worse, potentially health risks to you and your family. Like before, always do your research to find someone with a proven track record and required certifications. Your realtor can be a great help to provide you with recommendations here. Once you schedule an inspection, I recommend to meet the inspector in person. You don't have to be there for the entire process, but enough to be able to discuss with them what additional add-ons they recommend for the home. These can be things like a sewer line inspection, doing a radon test inspection, or a mold inspection. Once the inspection is done, within 12 hours, your inspector should provide you with the inspection results. Brace yourself. As you can see from this recent home I bought, the inspection will feel overwhelming. But not everything is cause for concern, folks. Only the critical issues and safety issues will be. So, although I recommend you to review all issues and ensure you understand them and their implications, really focus on the critical ones first. This is where another round of negotiation starts. Work with your realtor on determining how to approach this, as some homes may already be priced to account for the state of the home, while others may merit asking for a price reduction or for the seller to pay towards your closing costs. In the most recent homes I've purchased, what I normally do is coordinate with all my contractors and ask for quotes on all repairs that came out in the inspection, whether it be roof work, plumbing work, electrical work, HVAC work, and even an arborist if there are trees that may be a danger to the home. In my last 9 purchases, depending on the market and the seller situation, I have been able to successfully negotiate anywhere from 1 all the way to 10% reduction of the initial agreed upon price at this point. Just remember, if no agreement is reached, and if you don't inform the seller that you are backing out before your due diligence ends, then you will forfeit your earnest money if you back out afterwards. Okay, after the inspection and due diligence ends, let's assume that you are moving forward with the deal. Prior to closing, be sure to inspect the property one last time. This is really important, especially if, as part of your negotiation, the seller agreed to perform any repairs. But if the home was vacant and if there were no repairs that they needed to do, this step can be fully optional. But even if there were no repairs, if the home was occupied, you'll want to inspect it once the previous residents fully move out, just to be sure there wasn't any damage done to it during move out. Also, work with your loan officer and the closing attorneys to get all the information you need to schedule paying the down payment and closing costs. This will normally be done via a wire transfer. On the day of closing, if everything was done right, it will be a smooth process and only entails signing a ton, and I do mean a ton, of paperwork. This is also where your realtor will be your advocate that ensure that all the paperwork and everything goes smoothly. All right, folks, great news. After closing, you are now a homeowner. Take time to celebrate, but also begin planning on doing essential things to improve your initial experience as a homeowner. Here are some of the things I find that are easy and very important to do as soon as you close and prior to fully moving in. First, be sure to transfer or start all utilities such as electricity, water, gas, internet, trash. Second, plan on hiring or trying to do it yourself the following items. If you have a garage, reset the opener and reprogram new remotes. This is a security item, so please do it. Second, clean out the dryer duct. This is often disregarded, but it's important to extend the lifespan and efficiency of your dryer. Consider also installing new exterior locks with new keys. This is also a security item, but also a chance to personalize the door's hardware to your style. If moving in during the winter, make sure to protect your pipes from freezing up. This can be done easily by installing some foam insulation around any pipes that are visible. Another tip is to add your name on the inside of the mailbox to help reduce receiving mail from previous owners or occupants. And then the last tip, flush your water heater. A lot of times, a water heater is disregarded, and without annual flushing, its lifespan will potentially be reduced by up to half. And that's a wrap, folks. Please let me know what questions throughout any aspect of this entire process you may have in the comment section below. Also, if you have recently bought a home or if you are in real estate, please comment what else future homeowners should keep in mind. It's quite a journey, but with careful planning and the right support, you'll be unlocking the door to your new home in no time. Please consider subscribing to my channel to not miss out on any future homeowner tips, do-it-yourself DIY repairs and renovations, as well as content related to finance and real estate. Thank you for watching, folks, and till next time.